Hey everyone, I just wanted to make a video going over some ways you can improve your profitability. Now these aren't going to be the 4 best ways to improve profitability. There's also more ways than 4 to improve profitability. But I was originally making a video going over a certain trade style that I do. But I noticed when I was making the video I'd ramble on about ways to be, I wouldn't say more efficient, just be smarter. Reasonable things to do when you enter a trade and how to manage it and stuff like that. So I ended up making a slide deck to go over some of the points I was making in that original video. It'll help me keep on track for the most part as well. But the 4 ways I came up with, binary decision making, hold till disappointed, which is a trade management style, don't be ignorant, and then trade smaller. And I'll get into these starting now. Make your decisions binary. I think this is actually very helpful. And to the left of your screen, you see a flowchart. It's a visual representation of binary decision making, and I think this is very helpful. And it's actually kind of smart to have this up on another screen. It's actually what I used to do. Is I'd have flowcharts on my other monitor, and I'd just go through them. I'd answer all the questions, and then at the end of it, I'd have an answer, and I'd act on it. But I think there's an infinite number of ways to trade, which can get really confusing. And I think as newer traders, we believe that because the stock market is a complex system, that it deserves a complex method. And I think that's a bad way to look at it. Making your decisions binary reduces the number of options, which can prevent analysis paralysis. I know everybody's experienced that before. I know I have multiple times. And the worst part of it is you overthink a trade, and then you enter in because you feel left out, and it was just an extremely poor entry, and you get screwed over because of it. So I think just making your system simpler and quick and efficient will help you out dramatically. Fewer options gives you more time to react. If I have, instead of 2 options here, and I have 6, and then the next one I have 6, and here I have 6, it takes me more time to get to my answer, which can affect my entry. It can affect everything about the trade. The trade can no longer be valid at that point. So it's smart to keep, if you ever do create a flowchart, it's smart to keep it very, very simple and not to have it travel a long distance. And it's always important to remember there will always be another trade. When you feel left out of a trade, it sucks because either you're in chat rooms or you're watching videos or live streams or whatever it may be, and you see people making large sums of money. It's pretty discouraging because you either missed a trade because you were overthinking it, or you didn't see something you really liked, or didn't follow your rules. But you see all these people making tons of money, so you feel like you missed out, and you try and enter on a trade, and we all know how that plays out. It always plays out poorly. So it's always important to remember there will always be another trade. Um, there's a trade every day, no matter what sort of way you're trading. There's always a trade every day. And it's always important to remember there will always be another one. Hold till disappointed. This is actually kind of interesting because it's not the most profitable way to manage a trade, and the video is 4 ways to improve profitability. I think it's a good way to manage a trade, and it is a profitable way. It's also a good way to understand your emotions. Have an expectation of how the trade should play out. Think of how long, quick it should last, and the distance. The probabilities change when a new candle prints. Just exit when you become disappointed. So I know tons of people, they will enter into a trade thinking the probability, now I'm just pulling a number out of thin air, but they'll say, okay, I think I have a 40% chance here of making money. I'll adjust my take profit and stop loss accordingly, and I'll let it play out. But I think people forget, or they maybe don't even realize, that every time a candle prints, the probabilities change. They might increase in your favor, but they also might decrease against you. It might go against you. So if I see a wedge bottom here, a vacuum to some sort of support, I remember this day. This day was pretty recent. But this bear bar right here is actually a measured move to here. We have a wedge bottom, pretty strong sell-off with a range up here. It's reasonable to think we'll come back up. I'd say we have actually a 60% chance of coming up here. But if I enter in on this bar, so I just buy the close and I see a very strong bear bar, the probabilities have changed dramatically. It's no longer 60% in my favor. So whenever you become disappointed, you just exit the trade. And if you're happy with how the trade is, just stay in it. So had you bought the close here, you would have had this bull bar here. It's pretty similar in size. It's not the exact same size bar, but it's a pretty strong trend bar. We don't have a decent wick on the bottom, which means bulls did buy the close. And maybe the only reason why we have a wick on top is because the EMA is there. Maybe people are just expecting there to be some sort of resistance here, but this is for a pretty strong bar. I'm not disappointed with my trade, so it's reasonable to stay in. We have another bull bar. There isn't that much of a wick on the bottom, which means bulls bought the close, and it came up and closed above the EMA, closed above all these closes. I'm still not disappointed. It's reasonable to keep holding. And then we have a really strong bull bar here. This is pretty climactic. Some people say when you get some sort of gift like this, you just need to exit the trade, and that's reasonable to do, but we could continue higher. I'm going to exit when I become disappointed. And the next bar was a doji, which is disappointing, and you don't have to exit there. Some people might see this as not as disappointing. If they saw a stronger bear bar, that would have been disappointing, but a doji with a strong, like a 1, 2, 3, 4 bar micro channel up, some people will expect the first pullback will be minor, and so they'll stay in the trade. But I think it's reasonable just to exit when you become disappointed. If I bought this bar here and I saw this bear bar, I'd be disappointed. I think it's completely fine to exit. And by doing this, you sort of have an idea of what your emotions are saying and how to control them. So this is the same day. So this is an example essentially of when the trade doesn't work in your favor. But some people took this trade. They saw 1, 2, 3, 4 attempts to go higher. Maybe they think this could be a range day and we could come back and test the lows. They see a good signal bar and they want to sell. I don't think this is actually a good sell whatsoever. I think this is a really poor sell. Every time we've come down, we've had a strong bull bar here, here, and here. So, and you're in the middle of a relatively tight trading range, and it's best to just stay out of this mess. But some people thought this was a good trade, so they entered here. They saw this bull bar and thought, wow, that's really disappointing. I wanted to see a really big bear bar, and you didn't get that. This is disappointing, and this is yet another disappointing bar. So it's just, I'm very disappointed with how this trade played out, so I will exit. And had you left your stop up here, you could have taken a bigger hit. And I think the rest of the day, I think it did come down lower. But at that point, the premise has changed, and you just need to exit the trade. Whenever you become disappointed, just exit. I think this is a reasonable approach. Don't be ignorant. Don't be stupid. This is pretty self-explanatory. But the market is mostly 50-50 because it's a market. When you take a trade, someone's taking the other side of your trade, and that's what makes the market 50-50. Someone just as smart as you thinks they can make money doing the opposite of you. Most of us newer traders, we're not that smart when it comes to trading. But when JP Morgan or Citi or Wells Fargo or Goldman Sachs or whoever, Bank of America, when they take a large trade, there has to be another institution, an equally smart, just as large institution taking the other side of their trade. And so that's why the market most of the time is 50-50. It's more 40-60, but it's very close to 50-50. Don't get stuck on an idea or premise. This kind of plays with what I just said. Because the market is close to 50-50, most of the time you will be wrong. And you just need to accept that you'll be wrong. 40 to 60% rule. This sort of goes with how much profit you should be taking. But I use this rule as sort of 40 to 60% of the time I'm wrong. The last one is don't be stupid. This is pretty self-explanatory. I mean, if the market's just clearly doing something, just don't do the opposite of it. Some people might have saw this big move up. Maybe they saw a push here, pause, push here, pause, push here. So a wedge top being formed right here. They see a big bear bar with some follow through, but it's very poor. But then they see this, think, this is a great short. I think it will come to at least the EMA. I think this is a very reasonable short. Some people might think they have 60, 70, 80% chance of it coming to the EMA. But then this bull bar happens, and then this one, and then this one, and then this one. At what point do you become disappointed and realize you're doing something stupid and you should just exit the trade? This kind of goes back to the previous slide, which is trade till disappointed. If you took this short here, just exit when you see these two bull bars, or even this bar. You're counter trend trading, just exit as quick as possible and get out of the trade. Don't be stupid. Don't stay in this trade. Why are you staying in this trade when we're clearly in an uptrend? So yeah, don't be ignorant. Trade smaller. Now this slide sucks for every new trader because it means less profits. But the other side of that coin is it means less losses, and people forget about that. So whatever size you think you can trade, you think, I think I'm completely fine trading. I think I'm completely fine trading 1 E-mini. I think I'm completely fine trading 10 minis. It really, whatever size you think is fine, you really should be trading 1/5 to 1/10 that size. So if you think you can get away with 10 E-minis, you really should be trading 1 mini. And if you think you can get away with 1 mini, you should really be trading 1 or 2 micros. Trading smaller gives you flexibility and options. And I'll go over it right here. So this day was like relatively recent. I can't remember how recent, but it was pretty recent. But I think this is bar 18. By bar 18, you can kind of determine what kind of day it'll be. And this looks like trading range behavior with some sort of bearish bias, because strong sell-off here, strong sell-off here. Bulls failed to do anything here. But some bulls thought we're going to have a range day. So they bought here, hoping we'll have a double bottom and we'll come back to the top. We ended up not doing that, and we ended up going down. So they scaled in here. So they bought a second contract here. And then they bought a third one as it went further against them. And they were able to exit at break even on their original entry with a profit on their second and third. Now this happens quite frequently. It actually happens a lot. The issue is people don't trade small enough to handle this. Had you just trade one micro each time, you would have had $167 in drawdown. And then obviously times that by 10 for the 1 E-mini. As you've done 1 mini here, here, and here, you would have made $1,200 trading the E-mini, but you only would have made 127 on the micros. And I think when people see this, they get discouraged, and they just say, screw it, I'll just trade the minis. But your goal is not to get rich quick. Your goal is to get good quick, essentially. Stop making poor decisions. Most people are trading with a $5,000 or $10,000 account, and just because your brokerage allows you to trade multiple E-minis doesn't mean you should. And I think it's so much smarter to be trading micros. $167 is a surviving day. If you have a $5,000 account, this is a lot better than $1,600. Obviously, the trade worked out, but what if it hadn't? You know, it's better to trade 10 micros than one E-mini. This is, some people will disagree with this because they say, well, you have higher commissions. I think it's better to pay a premium to have flexibility with a trade. So I can scale in and out of trades. So had I just entered here, I could have exited some here and here, but then taken profit some here and then up here. It gives you a lot more options. When you're just in one contract, you either have to exit. You just have to exit or stay in. When you have 10, you can exit a few, you can leave some in. It gives you a ton more options. I think paying that premium is worth it. And yeah, trading smaller is just a very, very smart thing to do, and people don't want to hear it, but it'll help you survive. This is an example of what I was explaining earlier, failing. So trends happen because traders are trapped. 62% of days we're in a trading range. 80% of the time we're in some sort of range, but it doubles. But about 80% of that time you can make money doing both buying and selling. And then 20% of days, it's like this. 20% of the days, you've already made the lower higher of the day with bar 1. This is a 5-minute E-mini chart. And it just trends for the rest of the day. And the way trends happen is because traders are getting trapped. So a trader saw this high here, and they thought, we're going to have some sort of double top here. I think we'll reverse down. So they placed a limit order here. They got filled as price came up. They scaled in, and then they broke even on their original entry with a profit on their second. So traders didn't really get trapped here. But then they tried it again here. And this is when they got trapped. They thought, maybe we have some sort of wedge top here. I'm thinking we'll reverse, double top as well. I'll place a limit order here, expecting a move down, and it didn't. They scaled in here, they maybe scaled in here. This move was pretty strong, so you probably had a lot of bears exiting their scaled in positions. But they kept scaling in, and they never got bailed out. Because these traders are trapped, we had to move up. And it happened here as well. And then you get this big move at the end of the day, sort of all the bears exiting their positions. They all place their stops here officially at the end of the day, and they lost. They lost their position. It's never smart to trade by scaling in. A beginner, new trader should never do that. You should never scale in. But had you traded really, really small, you could have survived a brutal day like this. Had you traded your 1 E-mini or your 10 minis or however minis you're trading, you probably would have blown up your account. You probably would have ruined them. This is a positioning sizing calculator for the E-mini that Ali Afshari made. I'm not going to get too in-depth with it because I'm going to butcher the article he wrote, and I think everybody should read it. But it's, for the most part, it's you shouldn't risk less than 0.5%. You shouldn't risk more than 2%. This is kind of the window of optimal trading based on whatever your account size is. And you can plug in all the values. It's an Excel file that you can download, and I'll link it to the article. But you should really never be risking more than 2%. So whatever sort of capital you have, 2% should be the max. And it's determined by your stop loss. So if your stop loss is a certain distance away and you normally trade, let's say you always trade 1 mini, but the way you have to put your stop is at a position where it's at 2.2%, then you have to actually lower your size so that you're under the 2% window. So yeah, that's the video. Thank you for watching. If you have any questions, this was my first video. I probably did a poor job explaining quite a few things, but if you have any questions, feel free to leave them in the comments. I learned trading from Al Brooks, and you can find his trading course here. And I think it's tremendous value. He has a YouTube channel where they actually do end-of-day reviews almost every day, so I highly recommend checking them out. And then Ali Afshari, I've learned a lot from him. He's got a great YouTube channel, and he's also written a bunch of really good articles on the Brooks Trading Course website. But also feel free to join my Discord. It's a price action trading Discord. There's only a few members in it right now. But if you have any questions, feel free to join it. We have a bunch of really cool flow charts in there, helpful info, some other tools. Like if you use NinjaTrader, we have a bunch of tools in there that you can download. And then we have a bunch of other stuff. But feel free to join. Check it out. I hope you guys have a good day, and I'll catch you in another video.